Hi, before taking a brief tour of our investment management platform, let me explain why, after 12 successful years producing equity research, we decided to make our tools available to our clients. First, because we want you to be able to beat most ETFs, like we have done for the past 3 years. As you can see from this table, we have not only beaten all major ETFs, but have done so by a large margin of 10%. Second, because although there are many investment management platforms in the market, most focus on administration, accounting, and compliance, as you can see from the slide. Most importantly, even those who offer portfolio management rarely go beyond risk analysis. So, we decided to focus our platform on portfolio creation and monitoring by combining selection, analytical, and research tools. Thirdly, because I believe that it is better to choose stocks rather than ETFs. To see why, look at the two charts on the right side of the following slide with a summary of the price returns for the 3 months prior to the recent top of the market and prior to the COVID-19 market crash. We have grouped all 4,000 plus US listed stocks into 10 deciles containing approximately 400 stocks each and calculated the respective average and median returns for each decile. This way, we avoid the extreme returns which one would be exposed to by choosing just one stock, which can either wipe us out or treble our money. But aren't 400 too many stocks? They certainly are, and we recommend creating several portfolios of only 5 stocks. But how do we select them when most stocks rise during a bull market but decline in a bear market? We need to group them by a characteristic that one believes is correlated with good performing stocks. For example, most ETFs use market capitalization, which is depicted on the two charts on the left. Looking at the bull period in the chart, you can see that if you had chosen an equally weighted portfolio of big cap stocks, decile 10, which is close to the S&P 500, you would achieve a positive return of 5%, but still lower than the overall market return of 9%. While for the bear period, you would be slightly better than the market, which was down 38%, while your decline was only 34%. However, if you had chosen micro-cap stocks, you would be much better off with a gain of 20% in the bull period and a loss of 13% in the bear period. Now, will the micro-cap always beat the big cap? Nobody knows. Indeed, it would be great if one could travel in time and go to the future and draw these charts, but nobody can do that. Fortunately, there is something that we can do. We can see if there are other ways to group stocks that are better than market capitalization. For instance, we may look at the following slide with the compound annual returns implied in SADIF's price targets. In the left side charts, one can see that during the bull period, the top decile would easily beat the market with a 17% return, but would decline by 27% in the bear period, against the market decline of 38%. Note that no other decile would produce better results, but overall, the CAGR criteria performs better than the market capitalization. Of course, there may be other criteria, or a combination of them, for example microcaps with large CAGR that produce better results. So, the first tool in our screening section is the selection of the top 5 criteria among SADIF's 38 ratings, plus another 62 ratios and other indicators. Yet, the analysis of the deciles, averages, or medians is not enough. We can appreciate that by looking inside each decile at each company, as shown in the following slide. In the top 2 charts, we have depicted the bottom and top deciles for the bull period. We can now see that they cut the zero line at quite different distances. For instance, in the bull period, if we had chosen the big cap decile, we would only have 29% of the stocks with negative returns, but 43% if one had chosen the micro cap decile. If we had used the CAGR criteria, the percentage of negative returns would be 32% and 35% for the top and bottom deciles, respectively. While for the bear period, if one had chosen the big cap decile, we would have 97% of the stocks with negative returns, but only 83% if one had chosen the micro cap decile. On the contrary, if you had chosen the high CAGR decile, you would have an 89% stock with negative return. In bear periods, trying to pick blindly or otherwise a few of the 3% or 11% stocks with positive returns is quite a challenge. During bull periods, it's much easier because there are only 29% and 32% of stocks with negative returns. Still, we do not recommend doing so blindly. So, we provide users with several strategies and filters to help them to avoid negative returns. The end result should be a portfolio as illustrated in the next slide. You may get there using shortcuts and as few iterations as you like, but we strongly advise that one spends enough time analyzing and researching the final choice. The tools for backtesting, weighting, and monitoring are available and easy to use. Whether you invest for the short or long term, remember that investment success comes from choosing stocks wisely and knowing when to take losses and profits. Our tools will help you with both, but you are the one in the driving seat. Enjoy your tour of our platform, and if you need more information, just call us. We are here to help.